Hey everyone, it's Terry Gardner from CJL Lawrence coming to you from our global headquarters here in Midtown Manhattan. It's Wednesday, the 24th of July, on a pretty volatile day in the equity market. So I thought I'd come to you with some thoughts following today's market action. I want to cover three things today. First, I want to talk about the sector rotation and the sentiment change that's happening inside the market. Two, I want to talk about what I call the CapEx conundrum. And then third, talk a little bit about policy and election years, but really focus first off on the sector rotation that's taking place in the equity markets. You can see it with the winners and losers today. The top sector performers were healthcare, utilities, energy, and consumer staples. That came at the expense of technology, consumer discretionary, and communication services. So a complete shift into kind of defensive value from what has been working, which is some of the growth and more offensive sectors, if you will. And we've got precedent for this. We've seen something like this before. So I think it's instructive to kind of reflect on when this happened the last time, which wasn't too long ago. If you think back to 2022, we were facing in the markets the prospect of higher interest rates and the chance and the growing possibility for recession. And the higher interest rates were putting pressure on high multiple stocks. So we had this massive rotation out of technology, which had worked particularly well, and into energy in particular, but more defensive and value sectors. And it wasn't based on anything necessarily fundamental. It was more macro driven. It was driven by the prospect for higher interest rates and what the market playbook says that does to high multiple stocks, which is compress them. So I'm going to use Microsoft as an example to illustrate the point that you can look through these episodes if you focus on the fundamentals. So Microsoft, by example, was, and I'm not recommending that anyone go out and buy or sell Microsoft. It's not, but I'm using it as kind of a proxy for technology stocks that had worked particularly well that had a sell-off in 2022 in this market rotation. So from 2020, the beginning of 2020, so including the pandemic, to present, Microsoft is up 182%. From the period of time from 2020 to 2022, it was up 116%. So going into 2022, it had a great run. But it sold off in 2022, fell about 28%. But if you look behind the curtain and you look at kind of sales and earnings, revenues were growing at a double digit pace, and earnings grew about 11%, 11 plus percent in calendar year 2022. So Microsoft didn't do anything differently to precipitate this sell-off in the stock. It was really precipitated at a higher level, okay? And so the point that I want to make is if you had held Microsoft, rather than sell into the decline in sentiment, the fear of this rotation, if you had held the stock between the beginning of 2022 and now, you're up over 40%. So if you waded through it, if you sold it, you missed out on the upside that's been experienced since then. Are we going into another period like that, like 2022? I don't know. I could draw some parallels. It kind of feels like that. The point that I'm trying to make, though, is whether we are or not is if you focus on the companies of stocks that have the best fundamentals and that have secular tailwinds and that are disrupting industries and investing in the future, ultimately, you'll be rewarded. You may go through some short-term volatility and some market rotation and some sector rotation, but ultimately the fundamentals will win. And so that's the illustration I wanted to make using Microsoft and kind of thinking through where we are in this market environment, because some of the stocks that are selling off, that sold off today and may sell off again tomorrow, are growing at 15 to 20 to 25 to 35 and even higher growth rates. So we are selling off some of the fastest growing companies in the economy, and that's going to create some opportunities. Okay, secondly, I want to talk about this CapEx conundrum. That's what I call it. Capital spending is kind of a necessary evil in some industries and is a competitive advantage in others. In energy, you don't like to hear capital spending because the light at the end of the tunnel is kind of dim, and you'd rather see the energy companies return capital to shareholders than redeploy it back into their businesses that don't have the greatest long-term prospects, right? But in industries like technology and healthcare, we believe that capital spending and high levels of capital spending is actually a competitive advantage because it separates the pack and it deepens and widens the competitive moat that those that can spend have between them and those that can't spend. And so when I look back at the past couple of years at who the big spenders are and have been, they've been Amazon, Alphabet, Microsoft, Meta. Not far behind them is Apple. They have been the big capital spenders over the last several years, and I would suggest that they have achieved a reasonable return on that capital spending. On a near-term basis, and what we saw with Google today, Google reported their results, suggested that they were going to be maintaining a high level of capital spending. In this kind of environment, the market didn't like it because the market wanted a nearer term return on that capital. So the stock sold off. What it means for Google shareholders in the longer term is probably a higher return on invested capital, so long as they're investing their capital in the right places. And to our eye, they are in terms of their artificial intelligence investments, et cetera. And that's what these leaders are investing in. So we don't view high CapEx levels as a liability. We view it as an asset. We view it as a competitive advantage if capital spending is deployed and employed in the right areas, okay? And then so thirdly, I want to touch on what has really been in the backdrop over the last couple of weeks with the assassination attempt on the life of former President Trump, and then with President Biden's decision to exit the presidential race for the coming year, and the elevation of Vice President Harris as the candidate for presidency from the Democratic Party, right? And all the policies that these, and I should back up a step, the naming of J.D. Vance as the vice president candidate on the Republican ticket, all of these announcements, events, one which was particularly tragic, have filtered into the psyche of the market in one way or another, and they can push and pull the market on a short-term basis. But the point that I want to make is that on a longer-term basis, policy and elections don't have long-term impacts on the market. Now, if you had a chance to see the interview that I did earlier in this week, I was on Yahoo Finance with my brother Brian, who is the Washington policy analyst at Stifel. He had some unique perspectives on different industries and how the congressional mix matters more than actually who's sitting in the White House. I focused more on the market side, and that's what I'm going to do today. And by the way, if you want to see that interview, I'm happy to send you the link. But the point that I wanted to make was, if you look back in history and look how markets performed after events, elections, crises, the market ultimately finds its footing. For this exercise, this analyst used the Dow Jones Industrials because he went back a number of years. But the point being, if I look at a couple of events in our nation's history, like the Cuban Missile Crisis, which many thought was an existential threat to the U.S. back in the early 1960s, 6 months after the crisis ended, the market was up 24%. After JFK's tragic assassination, 6 months later, the market had returned 16%. After President Nixon resigned, we were in a time of constitutional crisis. In the mid-1970s, the market returned 12.5%. And I can go on and on. I'll just name the Asian stock market crisis in 1997. 6 months later, the market was 25% higher. So I can look at periods of time in our nation's history and in our economic history, in our market history, and make, I think, the conclusion that over longer periods of time, investors look through crises. I usually use the term looking through the valley, looking across the valley, and find solid footing on the other side, that markets can perform well, even on the back end of very difficult periods in our history. So if you have any questions about any of this or want some of this data, give me a shout at 212-888-6403 or email me at tgardner@cjlawrence.com. Look forward to hearing from you and hope everybody has a great rest of your week.